Inflation has eased in November, cooling from 5.9% in October. The reading now sits at 5.5%. This is the first contraction since July, but inflation still remains at the upper end of the Reserve Bank's 3 to 6% target range. A reduction in fuel prices was the main reason for the deceleration, but that was tempered by a sharp jump in the cost of food and non-alcoholic beverages. That category accelerated to a 4-month high. The increase was largely due to higher chicken and egg prices, as egg prices in particular were almost 40% higher when compared to the same period last year. Looking ahead, a Reuters poll in the meantime suggests that CPI will slow to 5% next year and 4.5% in 2025. And business confidence improved in November. The BCI, compiled by the Chamber of Commerce and Industry, rose to 111.5 points during the month. That's from 108.6 in October. Improvements in tourism and merchandise import volumes were behind the gains. But despite the rise, SACCI says that lingering economic challenges continue to be a drag on sentiment. And retail trade has declined. In October, sales fell back 2.5% from a year ago. It is the steepest decline since May and has disappointed the market, as many analysts had expected an increase of 0.9%. Retail activity has come under pressure as consumers remain severely constrained, and retailers themselves have to deal with challenges such as load shedding. In the fourth and final filing, Richard Spoor Inc. has filed a class action suit against Glencore. Over the last 5 months, Spoor has filed applications for certification of a class against several former and current coal mining companies in South Africa. The claim against Glencore focuses on negligence in training and safety. Similar to its previous applications against companies such as South32, Anglo American and Exxaro, the law firm is seeking justice and compensation for mine workers who contracted lung disease while working in the mines. And RMH has given its shareholders a reason to smile. The investment holding company is rewarding its investors with a total dividend payout of 327 million rand, as well as a special dividend of nearly 24 cents per share. This largely thanks to the settlement of the Atterbury base loan and settlements from Integer 3, totaling 254 million rand. The group also decided to return 73 million rand of the cash it retained from ongoing operations. Looking ahead, RMH says it's liquid enough to continue returning a maximum value to its shareholders. And Thungela remains on track to deliver on its full-year guidance. This despite ongoing rail challenges. Now, taking a stock of the year in a pre-close statement, the coal miner says that it will continue to truck coal from its operations to nearby sidings. This will allow further rail loading options while reducing the risk of train cancellations. This response is expected to help Thungela deliver on its full-year guidance, as it outlined in its interim results in August. Sticking with the sector, coal mining bosses want to lend Transnet a helping hand. The industry has taken the initiative to help the Rail and Ports Company procure spares for its locomotives. This as the impasse between Transnet and a Chinese locomotive supplier over spares appears to be far from being resolved. Since 2019, the SOE has struggled to get a service provider to supply spare parts for trains it obtained in a controversial deal. Earlier this year, Transnet was unsuccessful in finding eligible original equipment manufacturers to step in to help rehabilitate the locomotives. 200 trains currently stand idle due to a lack of spare parts. This weighs on the mining industry's ability to transport commodities efficiently. In international developments, Zara owner Inditex saw strong holiday season trading, with sales up 14% in the 6 weeks to the 11th of December, as it reported earnings in line with the analysts' forecasts and raised its margin outlook for the year. Let's take a look at this report for more.
Inditex is in festive mood. The Zara owner reported Wednesday's sales were up 14% over the 6 weeks to December 11th. The Spanish fashion giant said earnings were in line with analyst forecasts and raised its margin outlook for the year. It reported a net profit of just over $4.4 billion for the 9 months to the end of October. Sales in stores and online were up just over a tenth, slower than the near 20% growth of a year earlier. Inditex now sees its profit margin for the year rising, having previously said it would hold steady. That optimism flows from its policy of cutting store numbers and investing in larger, more attractive outlets. The firm is also trying to improve its logistics to deliver online orders faster than rivals. One analyst said the company's gross margin puts profitability up to levels not seen in close to a decade. But Inditex did warn that a stronger euro would trim sales by 4% this year. The results came a day after it was forced to pull a marketing campaign by Zara. There were calls for a boycott after some viewers saw the imagery of statues wrapped in white as evoking corpses in shrouds in Gaza.